background in banking and finance, and my vision was really to help individuals and businesses reach their wealth potential and essentially navigate what that means. So there was such a need for more holistic financial planning. So we really felt that there was, we could help fill that gap by talking through, whether it's retirement planning, budgeting, and really helping people to get generational wealth.
So first and foremost, we're going to talk about the economy forecast. We're going to talk about what happened in 2020 with the economy and 2021. What's going on, what we think might be happening, and this would help us dictate how we could plan out for 2021. So let's go ahead and go to the next. So let's look at 2020. First and foremost, we saw a record low interest rate, where at one time we saw the 10-year treasury below 2%. Below 1%, which is the lowest we have ever seen in United States history. Because of that, what we did see was we saw home prices increase throughout the whole country, besides the condos in San Francisco. Also, we saw two stimulus packages get done. One when COVID first happened, which some people saw that check, and then there was one that got happened in December for that last $600 check as well. When COVID first happened, we saw the S&P 500 where it dropped 34%, and then it popped right back like a rocket. It went up 68% as well. And then at one point, we did see 30 million plus people file for unemployment. But now in 2021, here's things that we're seeing, and we know that we have to look at in our crystal ball. One is the 10-year treasuries did creep up. So I talked about how interest rates hit all-time lows. We see that 10-year treasuries did creep up. Now, how does that affect you? One thing is that we're starting to see possibly start seeing the 30-year mortgage or mortgage rates going to eventually possibly creep up, along as other things we get for debt. At the same time, it might be good for savers, as now they're getting a better interest rate that they were getting on their CDs, savings, money markets, and annuities. We also have this thing that we're putting our head, I truly believe, in the head in the ground, and we're not really paying attention to. And we know there's a mortgage and eviction moratorium. And I know we keep having that can get kicked, but there's going to be a period of time when the mortgage and eviction moratorium will be lifted. And we know that there's going to be tons of people who might possibly get evicted or get foreclosed in this country. Now, here's some positive notes. There's a positive outlook right now on the vaccine rollout. We had COVID-19 last year. Now we have the vaccine rollout, and people, there's a positive outlook on the new vaccine. And then we have the Joe Biden election and him getting elected, and now he's in office, which some people might say which might bring some changes. One of those changes we have here is we have a tax reform talks, another stimulus, and different things happening for our economic forecast for 2021.
Right. So as we kind of give that a major outlook, and we want to make sure we also hone in on like the smaller picture things. So as far as 2020, we saw a lot of people were unprepared financially. And one of the things we like to start off with just to build a foundation is building up that savings and that emergency fund. So the rule of thumb that we like to use is to have 3 to 6 months of your expenses saved. Now, why do we want to do that? It's because you have to plan for things that are unexpected, the things that you can't foresee. So in 2020, we saw a lot of job loss. If people had unexpectedly got any illnesses, any education costs that came up, even things like transportation costs. So if your car broke down and now you need to have the funds to make sure that you get to work, these are all things that you need to consider, especially when you start to build that emergency fund and that savings. And one thing that I saw, especially in 2020, is the increase of people starting to invest and people starting to get involved in, the stock market and things like that. And before you kind of get with all the fancy things, as we like to say, you want to make sure that you have that cushion, right? So all of these things like cryptocurrency, Forex, people asking about GameStop today. So you want to make sure before you take those steps, you have that cushion and you're not putting all your money, let's say, in this stock that you've researched for forever and you think it's going to go up. Well, if things don't turn out the way that you think they are, we're going to see that you put yourself in a situation where you're not able to mitigate risk. So I always like to say, before we do all the fancy stuff, let's make sure that we have that savings and that emergency fund in place. And this is just the outlook on, the average American savings. And so this is basically, we've looked at the different age groups. Now, this one is from the Federal Reserve survey in 2016. I'm sure it's definitely changed in 2020, but this is the average. As you can see, it kind of goes up from ages under 35 to age 74. But as we start to look at over age 75, that kind of goes down, just because at that point you may be using your savings for retirement income as well.
And let's say another note. I always tell people, when it comes to savings, I always compare it to my big baseball guy. And when I always say, if you can't play catch, you can't play baseball. We can talk about bunts, stealing, squeezes, but if you can't play catch, you can't play baseball. And I think that's a lot of what we have to remember, is to make sure that our foundation and the basics are covered. Right now, I got 4 people calling me today about GameStop. Right? Know nothing about stocks. Might not even have a pot to piss in for a savings, but they want to get involved with GameStop because you hear the excitement and the sexiness of it. But if you don't have no savings, why are we even having this conversation? Like, if something happens with all the volatility of this thing where you can take a loss, you're going to be messed up if something does happen. And we see that more and more right now with COVID, where businesses were forced to shut down during COVID. We saw people who thought they had stable jobs and they got cut back. And we don't think that this is going to be the end of layoffs in 2021. I think we're going to see a lot more corporate layoffs during 2021 as companies notice that they can do more with less. And so we have to do proper planning, preparing for that. And just thinking that we're just going to buy some GameStop or some AMC, even though AMC is on the verge of going bankruptcy, is going to be the end all be all for us to the road to riches. We are mistaken by that. As building wealth is a long-term process. And when long-term, we're not talking about a month. We're not talking about 2 months. We're talking about it's a lifetime process to really build wealth, to produce the financial security that you're looking for.
Now, that's definitely a good point. And I think there's this dynamic of the fear of missing out on things. So you see people on social media posting about how they just made a ton of money investing, but you don't see the process and their journey behind it. And I think it's going to be different for every individual. But like I said before, as long as you have that cushion in between, it's not as hard of a blow if your investments don't go the way that you think they're going to go.
Right. And I think also a good point what you just said, and what that allows you to do when you have the savings, especially when you're investing, is you can have a longer time horizon to compare to somebody who doesn't even have savings. So right now, somebody asks me about certain things that I put money in. I say, hey, I'm not worried about it. This is for 10, 15, 18, 20 years down the road. I'm not worried about today, tomorrow, about the ups and downs. But if that's your last, you're looking at it every hour like, oh, this is the last money I have. So that's an excellent point as well with it. Next up, we're talking about access to capital. I think this is huge. I think a lot of people don't understand, who had access to capital was really able to take advantage of 2020. And I think you're really going to be able to take advantage of 2021. I truly believe that 2020 was the year that you got yourself prepared, and 2021 was the year that could take advantage of things. And based off what we're seeing right now, there's a lot of volatility in the marketplace. But I think with access to capital is going to help you ride these waves and be able to take advantage of things. Maybe not today, but I think down the road this year, you're going to be having opportunities of a lifetime. So a couple of things there was round 3 of the PPP loan. And if you don't understand the PPP loan, it was for small business owners to be able to get a paycheck protection plan or paycheck protection plan it was a forgiveness loan for small businesses. And we have round 3 of it, which means if your business had a down quarter any year in 2020 compared to 2019, you was able to take care of your payroll expenses, rent, and everything for 2.5 months. Also, we could also use the use of cash value life insurance to access capital as well. which means it's some of the names that they took advantages during the hard times and previous downturns who were able to use the cash value in their policies were Walt Disney with Disneyland. If you hear the story of Walt Disney, he used life insurance to help him start Disneyland, right? Walt Disney was horrible with saving money, which is actually his brother, who was the one who was the financial smart one out of the team, but it helped him build Disney World for it. Then there's J.C. Penney's, and then Stanford University, also as well, who used cash value life insurance as loans as for collateral for themselves down the road. You want to speak a little bit about that, Thandiwe, as well?
Yeah, no, those are all great examples of businesses that have used cash value life insurance. I've like just in reading the different stories for those specific businesses that are now, making millions. It's like they started off that you have to get the foundation of funding and financing your business. And when you've reached the point where you've done everything, you've got investors, you may have to take the investment out on yourself. And a lot of people don't know that that's actually you can use life insurance while you're living, if that's something that you can use to finance for your business. So even for Stanford University, what actually happened is part of it was funded by a couple, and their son had passed. So they used the cash to start Stanford University. And then years down, when they had the university, they had more troubles. And they didn't know how they were going to finance it because they had too many expenses. So they actually ended up using the husband's life insurance policy to help finance it and get it through those hard, rough years before they started making more of a profit into now, being a very, very well-known university. So yeah, that's all I'd like to add to that. And as we start to talk about developing relationships with your banker, I mean, this was a huge one, especially for people who didn't understand, okay, why is my PPP loan not processing as fast? Whereas people who had, maybe they were going to big banks and they didn't have those relationships. So starting to look at those mid-sized and small banks in terms of being able to access money and access to capital is really important.
Yeah, and that's huge. I remember one of my cousins, she was like, I applied with one of the big four banks. I ain't going to say no names. I haven't got the word back. It didn't hear nothing. But I told her, I said, hey, talk to this person, talk to this banker. They're going to take care of you. And at first, my cousin stubborn. She wanted to hear me. She got stuck in believing in one of the big four banks. And I ain't going to tell you their name. I just tell you they have a stagecoach. But anyways,
messy.
But anyways, what's crazy about it? So she went to the bank I told her to go to, right? And the bank, she went to that bank, and within that same day, she got money for her small business with the PPP program. And that's all. She opened up an account that day. That evening, she got money. And once she got that money, the following day, she got a letter from Wells Fargo talking about having the issues that she did have. Now, what does that tell you? Small and mid-sized banks, we often forget about those small, mid-sized regional banks, but oftentimes they might have the capital in the relationships you have with them are important. Now, am I telling you should not have an account at the Big Four? No, but I think those relationships helped out a lot of people to have access to capital, where compared to people who only have money at one of the Big Four banks and they have those relationships. So oftentimes when we don't have these relationships in these dire situations, we're calling this 1-800 number. You can't get through. You can't talk to somebody. But actually know who your banker is will allow you to call on a cell phone and answer those questions. I was talking to one of my clients today who owns a nonprofit in a business, and I called my banker, and he answered those questions for him on what to do to apply for the PPP program. He never did before. And I asked him, is round 1, round 2 available, since he never applied before? And the person said yes. And he gave him the details. He walked him through all the steps that he's going to be taking. And that would not happen if you just call 1-800 number. So it's highly important that we really develop those relationships with our banker. Know your banker name. Know the first name. When you go to your bank, just don't always go to the ATM. Deposit that regular check to an individual. Find out who the banker is. Shake their hand. Know who that person is, because they might have something that you're looking for, or you want to build that relationship, which I think is highly important.
That's definitely. And even Yeah, I've seen that with so many businesses where, they didn't have somebody who was on their team. And then we saw like a lot of larger businesses who got the PPP loan rather than, smaller businesses who really needed it. So I think that's definitely a super important point. And then something else is really like relationships with your family. A lot of us, it can get pretty tricky sometimes when it comes to family, but I think if they're able to help you save your business, that could be a potential way that, you can have access to financing the non-traditional route. Like a lot of times we think, okay, we're going to go straight to a bank, but it takes a number of years for the bank for you to have your business established before you can even get loans through the bank. So knowing that requirement, you may have to, go to leverage those relationships with family in order to sustain your business or even to get your business started. So I think that's another good thing as well.
Hey, Tanner, that's a great point. I know everybody's buying things on Amazon right now, but where did Amazon get first 350,000 from? Family.
Right.
Right? We talk about Bill Gates and we talk about Microsoft, and Bill Gates being one of the wealthiest people. We hear everything in the world and we're hearing everything about him and the vaccine right now. But where did he get the money from Microsoft? His father, right? We hear about Starbucks and Howard Schultz and how he had to raise all this money to buy Starbucks because he took it to a whole nother level. He got that money, a lot of that, he got that money, his startup money from family. So don't think that family is not. I think this period of time, family and your family name is highly important. Not just building wealth for the future for your kids, but it allows us to help take us to the very next level and when we find opportunities. And if there was no family, would be no Barack Obama because he got his mother from his grandmother. He got his 500,000 from his grandmother. Would there be no Howard Schultz? There'd be no Starbucks. We know there would be no Amazon, and there'd be no Microsoft. And those are just a few companies. So we need to make sure we have a great relationship and able to talk to our family about accessing capital.
No, I think that's a great point because all of those businesses and those people that you've named, a lot of time we have these ideas that they're just quote unquote self-made. And when in reality, they had people who are close to them kind of helping them out as well. So there's a lot of resources and stuff out there.
That's what,
Yeah, go ahead.
now I'll just say I think this whole self-made bootstrapping thing is in American history we talked about is really just is BS. It's not really true. There's people, nobody does anything on their own. Everybody needs help. And I think that's why we're here to help you. That's why we have this seminar to help you. So don't think you should be on an island. If you read the 48 Laws of Power, one of the worst rules they have is no man should ever be on an island, especially during trying times. And trial times are here right now during COVID. I think, but there's opportunities for people who's not an island, but are connected with people and put bridges and connecting and having those relationships with family and friends for it.
That's definitely.
And then last but not least, small business grants. Right now, there's more and more grants coming out. I know San Francisco has a small business program, relief program coming out. You should look at CA relief grants are about to issue out more money for February. So here's just a couple of places for grants that you should be looking for as well. Remember with grants, you don't have to pay it back, but you do have to hit the requirements that they want to reach to have those grants.
No, that's a great point. And one thing, especially we were discussing was looking at your like local grants. And so looking at local grants that are specific maybe to your county or your city. And then another thing is also looking at different chambers of commerce. So for an example, even the Oakland African American Chamber of Commerce, they did an excellent job at raising funds for small Black businesses in the Bay Area. And I think a lot of times we think, okay, there's not enough capital for me to sustain my business. But if you really do your research and see what's out there and have the right connections, there's a lot of grant programs that can help your business be sustained. It might be some paperwork sometimes, but they're definitely out there.
Major kudos on that to the Oakland Chamber for that. Last, I see we had a question regarding this as well. Let me say this: with the PPP loan, is more for the established businesses and not for any new business you want to start, Erica. So the PPP is probably not designed for you. But what I would tell you to do is you might be able to find some type of programs with the bank or these grant programs for new startup businesses. So what I recommend is call your banker, have that business. First of all, let me say this. If you're trying to start a business right now, go to your SBDC, which is the Small Business Development Center. There's one in every region of the Bay Area or throughout the country. We got people all over the country, possibly the whole world. But let's go ahead and put together the business plan, work with them, put together a business plan. After you put together that business plan, talk to your banker, talk to your family, and you might have money there. But if we're going out there with nothing in our hand, talking about the specifics, our business, our mission statement, our vision, our financials with them, we don't have it. But when we know exactly what we're doing and we present it to our banker, and they can look out and can tell us what programs they are in our chamber as well.
That's definitely a good point. So I'm going to be talking a little bit about handling debt because, as we know, if we didn't have an emergency fund or some things in place, we may have taken on more debt than we usually had in the past. I know there's just definitely been a lot going on, especially with student loans. So as far as paying off debt and being able to handle debt, if you have a lot of debt on credit cards, it might be a good option to see what kinds of personal loans that you can get. They are out there, and there's different financial institutions that do offer them. And the reason is because if you know you're not going to pay it off immediately, and it's going to be over a longer period of time, you want to make sure that you're getting a lower interest rate, which you're going to see as well. And as far as strategy, I know some people may have heard of this debt snowball or the debt avalanche. And really what that is on one side, you can pay off the credit cards or the loans that you have, maybe that have higher interest rates first, versus you can also do it where it has the lowest balance first. Either way you do it is fine. Some people ask me what's better. I wouldn't necessarily say one's better than the other. I'll say as long as you find one that fits for you and you get started and you have an actual plan put into place of how much you can contribute to handling and managing your debt, that's all that matters. So really just getting started, essentially. As far as borrowing restrictions, we saw in 2020 the credit markets on the personal side was a little bit more open. In 2021, we're seeing that could get a little bit tighter and more restricted in terms of access to capital. So basically what that means is if it's going to be a lot, maybe the restrictions, it's going to make it harder to borrow rather than before. And then the last thing is just interest rate. So 2020, we saw the lowest interest rates ever. And now in 2021, we're starting to see those creep up. So two populations I actually want to mention in terms of interest rates is for people who are homeowners. If we had a lot of people who are refinancing their homes because they're able to get lower interest rates. And then on the other side of that, the home buyers who are also taking advantage of that as well. However, people who weren't necessarily having an advantage from those interest rates were retirees who had a lot of their income tied to the bond market. And because it was less interest, it kind of lowered their retirement income as well. You want to add to anything on that?
Yeah, definitely. I think the big thing when you talk about is personal loans are huge compared to credit cards. One thing we saw was, lower interest rates were great. And we saw that with the personal loans for if you went to your bank or your credit union. Credit cards, even though interest rates did drop, credit cards interest rates still remain the same. And the average American is paying 20+% on credit cards, which is a huge amount when you think about it. And so that's something you definitely should consider if you're like, man, I got all this debt, credit cards, I don't know how to handle. One thing in handling debt, we're going to also see with this administration, is there been talks of student loan forgiveness. Nothing's happening there yet, but one thing I'll tell you to look out for 2021 is pay attention to Congress and see if there's going to be some type of student loan forgiveness. There's rumors that might be $10,000 to $50,000. We don't know all the dynamics, if it's going to be income-based or how they're going to do it, but look out for that. Also, the last token I want to say with handling debt, I know some of you guys right now are looking for ideas and strategies on how to make more money. And one thing you possibly want to do is find somebody. I'm sorry to say this, sorry to sound like a vulture, but you might want to, during these times, with you having the power to access capital like we talked about, and you know how to handle the debt, might bring opportunities a lifetime for you to find people who might be struggling with their debt and cannot handle with all the debt. And this might be able to help you with some of the people who can't handle their mortgages and the debt they put upon their mortgages, to see if there's any opportunities to work with them for you to purchase or take over their mortgage note as well. So I think there's about to be some creative financing coming into 2021, especially as credit markets get tighter and people won't be able to access credit. And there's this huge amount of people who might get unemployed or having a tough time.
Yeah, I think you're definitely right. I think you're going to see more creative financing in 2021, even when we start to talk about financing for mortgages, because now that the restrictions may be getting tighter for banks, there may be something like seller financing start to increase as 2021 goes on.
Right. And there's a great book about that as well. It's called No Money Down 90s Style or 2000 Style. Find it on Amazon. Great book about creative financing. Read it. Once again, No Money Down 90s Style. If you're thinking about doing creative financing, going out there, it won't be obvious to find deals right now, but I think in the second half of the year, we might be able to find some deals with these eviction and foreclosure moratoriums. Indeed.
Definitely.
So now let's talk about protection. Like I tell you guys, I love talking about the fundamentals, right? I coach baseball. I have a 12-year-old, and I always say, if you can't play catch, you can't play baseball. While I'm holding my funko, just relaxing while seeing them play catch, and Crick telling them what to do. But first and foremost, let's talk about protection. So in the beginning of COVID, there's a huge amount of people who was like, the world's coming to an end. I need to get life insurance because of COVID. Underwriting for the life insurance market got a lot tighter, where we was having in the beginning, and then it started opening up at the end of 2020 as insurance companies noticed that it was not going to be as bad as they originally thought for COVID, which is very interesting since they're actuaries. So the problem happened mostly with people who had health issues before, and over the age of 70, we could not insure them. But what we're seeing now is there's certain insurance companies who's actually lift up to 70 years old and insuring people who's older. We also seen that health issues might not be as important now. There's actually one of our vendors that we work with who is actually raising the limits on without having an exam up to $7.5 million, which they just announced yesterday, which is crazy. Think about it. We're in COVID, no blood, no urine, nobody come to your house, $7.5 million based off of you saying that you're healthy and that you answer the questions. Honestly, that's a huge thing for that. Also, the longer you wait I always like to talk about the longer you wait to get insurance and coverage, the more expensive it's going to be on the life insurance side. And then one thing I think people fail to realize is the importance of health insurance. So if you don't have your health insurance taken care of your employer, one thing we should look at, and when we talk about it, is Cover California got extended to January 31st, which means this: if you have not applied, if you don't have health insurance, you haven't applied yet, this is a great time to get health insurance if you're in California, as Cover California did get extended to January 31st if you thought it was too late. Now, another thing I was talking about with protection is consider, if you can and you're a healthy person, consider a health savings account for yourself, which means usually a high deductible plan. You could put the money into a savings account and that money could grow over a great way. Now, the money you put in there is tax deductible, but when you take it out for medical expenses, it's also tax free, which is a huge tax saving. I love that tax strategy, and then you can to take advantage of it.
Yeah, and as we kind of talk, I'll go a little bit more detail about, because I think both of us have had clients or people that we've worked with that we've had a little bit more trouble insuring based on different health issues or people who are over the age of 70. So what does that look like in terms of like the cost of waiting? So this is the example that I wanted to show. And we used a term policy to make this illustration because a lot of times we hear, okay, it's too expensive, I can't afford anything. So this is what it would look like. Let's say we have Sarah, who's age 30, preferred non-smoker, on a $1 million term policy. And we look at it and the estimate quote would be $37 a month. Versus, let's say that 20 years goes by, not insured. Now Sarah's like, okay, I'm ready to finally get that insurance policy. Her health has changed a little bit. She's now 20 years older, and that same policy is now $205 a month. right? So even though you might think to yourself, okay, I'm too young, I don't know if I necessarily need to do it, the cost of waiting tends to increase. And even though we've used the life insurance example to illustrate this, this is the same thing when it comes to investments, when it comes to, anything from retirement planning, real estate. You have that time in between that it allows it to grow and create more value as time goes on, right? So you want to make sure you know your options and you're not just kind of, sitting on your hands waiting on things. You want to make sure that you can make that possible before it's too late. So I think that's an excellent point where I see more people looking for protection, because you can have all the fun you want in terms of like the stock market and things, but you want to make sure that your assets are protected, because you don't want to lose them. Essentially, it's too much risk.
Great point.
Yeah. So let's go ahead here. So as we kind of wrap things up, I know we covered a lot of different topics here and there, but we wanted to go over any questions that you all had. If you can put them in the Q&A or the chat, we'd love to answer them for you and go over that. I think I saw something there.
Also, I want to say next month in our talk, we will be discussing the Joe Biden, way he's discussing in his tax reform bill based off what he was mentioning and how that might affect your pocketbook, as all of us hate paying taxes and all of us want to figure out how to minimize taxes. So we will be discussing that as well. Question for you guys as well. What topics do you want to learn more about in 2021 when it comes to money?
Okay, I see somebody has a question. Oops, hold on, I think I lost it. Jason, do you see that in there?
Yeah, it says, can you contribute to after can you contribute to or no longer have you say if I repeat right, it says, can you contribute if you no longer have an HSA with after tax dollars? If you don't have a high deductible health insurance plan, you cannot contribute to a health savings account plan. So that's it. But if you do have a high deductible health savings plan, then you can contribute to your health savings account, which they go hand in hand. Also, regarding that as well is this: if you're a small business owner and you have more than this is great for small business owner tip. If you're a small business owner and you have more than $3,000 worth of medical expenses, you might want to look at a health reimbursement account. What a health reimbursement account do for small business owners is you can deduct all your premiums, your co-pays, and any deductions that you have. I personally use that. And the reason being is this: my wife, she has a regular health insurance through work, but with me, but we have an autistic son who's 3.5 years old. Every day we have a therapist who comes with him every day. Every day he has a therapist. He has speech, and all those things add up. To make sure all that's deductible when we pay for all these co-pays of the speech therapist, the ABA therapist, the occupational therapist, we open a health reimbursement account. And with that health reimbursement account, everything that goes along with him, my son who's 12 years old, who's about to need braces, all that is now tax deductible. Even though I hate paying for these expensive braces, even though I know he needs it and I hate paying for it, at least I know it's tax deductible. For small business owners, once again, look at an HRA or health reimbursement account. Make sure you do talk to your tax advisor for further details, but it's a great thing to mention when you do bring it up to them.
Yes. And so I see another question: what's the best way to improve or build credit? That's first is going to depend where you're at. If you have no credit versus if you just have bad credit. And in terms of like some of the best ways to build that up or to improve on your credit is really, there's ways to increase your credit limit. paying down the debt, the ratio, so you're not utilizing the full amount that you have available. If you have anything on your credit, sending letters to take those off potentially is a good thing to do, but you need to make sure that you work on it depending on like if you're going to be purchasing a house soon. You want to make sure you have that in place to improve your credit before that.
Yeah, I'll give an extra couple tokens behind it as well.
Yeah.
What I will tell you is every month, what you should try to do is try to pay off your credit cards every month. That should be it. If you can't, try to keep your credit cards below the 30% utilization rate. Make sure you have, I always recommend trying to have 3 to 4 credit cards and make sure you keep each one of those below that 30% hold. Just like Thandiwe say, go to look at your credit report. Go to annualcreditreport.com. Due to COVID now, you can pull up your credit report every single week. If you see something wrong, you see something fraudulent, you see, man, that should not be there. You fight that off once you go in there. You can pull up your credit report. It's not going to hurt you. And you could go ahead, it's not going to hurt you. But you could go ahead and look at every week and you go ahead and go ahead and fight all those things. If you don't have a credit, like, man, my credit's jacked up and I can't get 3 credit cards, get a couple secure cards. Do the same thing. Get the 3 credit cards, even if they're secured. Have them below 30%. Keep paying for them every month on time. Once again, on time below 30%, your credit score will naturally go up. You don't need to pay one of these credit agencies unless your stuff is super jacked up because you had your parents who put your mama put your name on the PG&E bill growing up and everything else. But for most of us, we don't have that situation. So if you just do that thing, keep pay all your things on time, credit cards below 30%, pay them on time, and we'll fight everything that's fraudulent. You should be okay for most of us. Now, that's what I recommend for that.
Yeah, and I would definitely also add to that of like not spending too much money on like the programs for credit repair. These are things that you can also do yourself or working with someone like a financial advisor to help you put that in place and increase your credit. But I know there can be some pretty pricey programs out there, so just to be aware of that as well. So let's see. I think we had another question. What are your thoughts on Roth conversions? Good time to take advantage of it. Did you want me to go first?
Yeah, go ahead.
Okay.
Or I can answer. It's up to you. Go ahead.
Okay, I'll go first. I guess my opinion on that is you have to be somewhat careful with how you do it. I mean, if you're converting it, obviously you're going to be there's going to be tax implications on that, and trying to time what's the best time that taxes are going to benefit you is going to be important. But you never know because they're going to change. So I would say it depends on your situation of when you want to do that conversion, and also depending on what you need the money for. I think that's the main thing as well. You can't control what the tax rates are going to be like.
Definitely, you can't control the tax rates. I think if you have a bigger time horizon, it depends on your income, your time horizon is a huge thing. One thing I think people get messed up about Roth conversions, and I love Roths. I love everything that's tax-free in this world for having a tax-free retirement. But the problem with Roth conversions for some people is they forget when you roll over, when you convert your IRA to a Roth IRA, you're going to have to pay taxes if you're below 59.5 for that. And it cannot come out of your retirement account. It cannot come out of the IRA to Roth. It has to come out of your personal savings. So what I recommend is talk to an advisor, figure out how to do the conversion, and maybe you might have to do a drip thing and do it based off of how much money you have in savings. Because if not, what happens is when you convert it, then you have to pay tax on the difference. And people are like, whoa, I didn't have that money. And now they're in a bad financial state from doing it. So talk to an advisor, have a drip. Because remember, you have to come out of your personal savings or other accounts. You cannot come out of a retirement account for that conversion. But I love it. But I think that, it depends on how much money you have, what's your time horizon, how much money you have in your savings and cash on hand, your time horizon, and what your income is going to be now and where you might see in the future.
Right. And also like what your goals and your objectives for it is as well. Because there may be ways to hold off on doing the full conversion rather than just doing the full thing. So
Right. That's a huge thing. And some people might not be perfect for it as well. I just talked to one of my clients earlier today. One of my clients earlier today who's retiring. She's going from having a $140,000 a year job to $40,000. So it's not a big deal about converting a couple years ago for her. So we just didn't do it because her income's about to be very minimal compared to what it is now.
Right. So we'll go ahead and start wrapping things up if we don't have any more questions. Do we have any more questions?
No, these are really good. I hear some of you guys want to hear about real estate. We might bring in somebody into real estate. Yasmir, thanks for getting on. Yasmir, do you want to hear more about residential real estate, commercial real estate? And if so, what type of real estate do you really want to hear about?
Well, while we're waiting on that, we can go ahead and if you like what you heard today, like Jason said, we're going to be doing this every month, and we're going to be covering different topics. So stay tuned for that. And if you're also interested in hearing things further, you're ready to get your financial house in order, feel free to also book with us. Now, because you attended the session, usually the regular price for meeting us with us is $300, but we will do a consultation for free, especially, 2021, getting the year started. Feel free to check us out. We put our website, phone number, and email address in here as well if you'd like to copy that down. And just thank you everyone for joining us this evening. I know for some of you who have done work all day and still chose to come to this workshop to get some gems. Hopefully you are able to learn something new. And so we're definitely grateful for that.
Yeah, definitely. Thank you guys all for coming on tonight. I know some of you guys are on the East Coast, and I know it's 9:49, so I really do appreciate it. So
right.
Definitely appreciate it from our East Coast people especially. But thank you all for getting on the call tonight. Thank you again.
Yes, thank you. And we will also be sending an additional email if you signed up with us. And so like if you would like to move forward or discuss, had any other additional questions, we should be here to answer them. So again, thank you. And I hope everyone can enjoy the rest of their evening.